You're listening to The Preferred Way, a retirement podcast brought to you by Preferred Trust Company, the preferred custodian for all alternative investments.
Welcome, everybody. Thank you for joining us today on The Preferred Way. Today, we have Nam Phan from Pacific Private Money joining us today. We're going to talk all about them, which is super cool, what they do, how they got started. So welcome, Nam. We're glad you're here.
Thanks for having me. Looking forward to this webcast or podcast.
Yeah, absolutely. All right. Well, 2008, that's where when you were founded. So tell us a little bit about that. Tell us how Pacific Private Money came to be.
Sure. So Mark Hanf, who's the founder and CEO of Pacific Private Money, first he apologized for not being able to attend today, so I'm stepping in for him. But in terms of when and how Pacific Private Money started, Mark's family comes from a family of builders, developers. His father was a prominent builder here in the Bay Area, specifically in Marin County. And he was part of the family business. He was running the back office for the company. And, as many builders do, they get private money for a lot of their projects. So he was familiar with being the borrower on the private money side. And in 2007, 2008, he had an opportunity to start his own private lending business. Familiar with, all of the borrowers in the marketplace in Marin. So he and his wife, Lisa, really started as a mom and pop private lenders, like many across the country do, lining up individual borrowers who needed a loan for like a fix and flip or some kind of investment with local high net worth individuals who had spare money that they wanted to lend out. And so for several years, that's how they operated, really matching individual borrowers with a number of private trust deed investors. He did that for a while and really built a great reputation for delivery, friendly service, and for really certainty of delivery, I should say, because that's what a lot of borrowers want with private money, because they usually need it in a hurry. That business grew and thrived because of the reputation, and he grew his team. It expanded where Pacific Private Money lent. So by 2013, they were all across California. I was fortunate to join the company in 2015, and we've just been expanding ever since then. So
well, that's an interesting place for you to stop, because I was just going to say from 2015 to about 2021, you really grew like over 700%, like from your loan originations being 50 million to all the way up to over 400 million. Like, how does that happen?
Yeah, we just built on a reputation, and we were also growing our team. And I have to say, I'm super proud of the people that we have here. I think we have a lot of people with great experience, but more importantly, they're the right kind of people you'd want in your company. Really professional, sharp, really good at what they do. And so we had a growth period, as you mentioned, due in large part to growing our team of loan officers who are in the field every day talking to borrowers, mortgage brokers, other lenders, and letting them know about our products. That and also our expansion into other markets outside of California. And so, we experienced a lot of really good growth then, and we continue to grow, although the last couple of years have been tough with the interest rate environment. But overall, it's been a great story, and we're super bullish on 2025.
That's awesome. So tell me a little bit about the expansion into other areas outside of California. Is there a specific area? Where did your expansion occur?
Yeah, our expansion occurred, opportunistically. We would see deals come in from around the country because of just our network. And so we would start seeing loans in New York, on the Eastern Seaboard, on the West Coast in Arizona and Colorado, but more intentionally, we got licensed in 10 additional states, so we can do consumer lending, because we were one of the few private lenders who actually offers a consumer loan product, and it's specifically a bridge loan, a loan that somebody allows a homeowner to buy their next home before they've sold their departing residence. So a hugely underserved market, but it requires a consumer lender's license, which we have now in 10 states and we'll have in 20 next year. and it's done through our spin-off company, Arrival Home Loans, but it's still part of Pacific Private Money. So fast forward to today, we're now operating in 10 states for consumer lending, and then just again, opportunistically wherever we see deals for like ground up construction or multifamily or just your typical kind of fix and flip or DSCR loans, longer term 30-year for, people who want to buy portfolios of investment properties.
Well, that kind of shifts us to the next part. I was going to talk a little bit about what type of loans that you offer and the different types. If you can kind of go over that with us.
Yeah, and that goes kind of to why we've had a fast growth, trajectory over the years, is because, a lot of private lenders focus on a specific type of loan, like, lender A could be, hey, we're fix and flip. We're the fix and flip guys. Somebody else could be, we're DSCR specialists. We tend to, offer maybe I'd say the most diverse loan product suite of, most private lenders across the country, because we have the expertise to do it. So we have teams of underwriters, processors, and really loan officers who know how to structure, whether it's a consumer bridge loan or a DSCR loan or fix and flip. It's allowed us. We wouldn't do it if we didn't have the inherent knowledge on how to do these loans, but also on having the takeout, because a lot of the loans we originate, we sell to the secondary market. Okay. And so really, we have to have all of those things if you're going to jump into a specific loan product or market segment. And fortunately, we have the right people to do all those different types of loans.
That's awesome.
Yeah.
So let's talk a little bit about investors. Somebody who's interested in being on the investor side of things. How do they get involved?
So they can get involved, in a number of ways. They can invest through like how we originated, how Pacific Private Money started, which is investing as an individual on a specific note. But probably better would be to invest in a fund, of which we offer 4 different funds. And the funds all have different use cases, but essentially they're mortgage debt funds where we, aggregate individual investor, investments into a mortgage pool fund, and then we go out and make the loan. The nice feature about mortgage funds is it's diversified across a portfolio of loans versus an individual loan. And so investors who want passive income, want to be involved in real estate, but maybe don't want to invest directly in a specific property can invest in a fund. And, Mark always says, private money, private lending, it used to be the best kept secret. But now it's really expanded to a lot of retail investors. The nice thing is you can get really healthy returns on your investment. These days, anywhere from 7 to 10+%, depending on the fund profile. So, that's investors are increasingly becoming aware through, companies like Preferred Trust, through our own efforts. But really, it's a market segment that I would say is still underserved for investors. And so the more awareness we can create, the better, because again, the returns are really healthy and they're fairly stable compared to the stock market or other investments.
Sure, that 7 to 10% is definitely attractive, which kind of leads me to my next. A lot of people start out with that investment as a cash investor, but they can invest using a self-directed IRA. So now let's talk about that and what that looks like from your perspective.
Yeah, so we have really healthy, about a quarter of our investors in our funds are investing through a self-directed IRA. Actually, I think that's the cap. 25% is the cap, and so we're right there. I mean, and we have investors who are have money in a maybe a traditional IRA, but that traditional IRA doesn't allow them to invest into alts like ours. So the fortunate thing is there are self-directed IRA companies like Preferred Trust who allow you to do a rollover if you have it held somewhere else. You can do a rollover and then invest directly into our fund or funds. Nice thing is you're instead of taking monthly distributions, you're reinvesting it and compounding that. So imagine you're earning 10% on a fund and you're reinvesting well, you're actually earning more because you're growing your principal. So, there's a lot of opportunities to, whether it's Pacific Private Money's offering or any number of private lenders out there who offer funds, all of them generally accept self-directed IRA monies. And, we love that.
Yeah, we always say too, like, you don't have to invest in the same thing all the time. There's so many alts out there, so many different ways to invest. People are interested in real estate, but there's a million different ways to invest in real estate. There's so many options and variables out there. So tell us, do you allow clients to invest in more than one like fund with you, or different aspects of investing with you?
Yeah, absolutely. So, one investor could have for instance, one account with you, but within that account, they can invest, let's say they have 200,000, they could invest 50,000 in one fund, like the, Pacific Freedom Fund, or they can invest 50,000 in the Pacific Southwest Note Fund. Or, they may want to diversify outside of Pacific Private Money and say, hey, I want to invest in a fund that's focused on East Coast real estate, which, the majority of our real estate is the Western states. Go ahead, go look at those fund offerings by lenders on the East Coast. We're not the end all be all of all lenders, but, we know what we specialize in and what we're good at. And, there's probably some other funds out there that allow you to diversify, even though you're investing in real estate. It's real estate that's in another state. So there's different, but to answer your question, yes, they can invest, in more than just one of our funds through the same one account they have with you.
And do you have a minimum investment amount? I heard you say 50,000. Does it change depending on the fund? Is that a set amount?
Generally, with each fund, there is a minimum. So the Southwest Note Fund is 50,000. Actually, I mentioned 50,000 in the Freedom Fund, but the minimum there is 100. Okay. So you can certainly invest more than that as a starting point, but most people invest like the minimum, see how it works, and then they can add to it. But generally, it's 50,000 or 100,000, depending on the fund. There may be times when we may lower it, but generally, those are the floors for them. Our Opportunity Fund, as an example, is also 100. We just launched the Arrival Fund, which is a fund focused on consumer bridge loans, and that minimum investment is 100,000. So generally, rule of thumb is about between 50 and 100,000.
Okay. All right. So now there's the compliance end of things, and what investors really need to be looking at when they're considering making an investment. What are the things that they should focus on? And how do you all stand up against others in the industry?
Yeah. If I'm an investor looking into investing in the mortgage pool fund space, I would look at a number of things. One is just the track record of the originator, the lender. How long have they been in business? How big is their team? And when you look at their team, though, you want to see, these are things you want to look at. Who's doing the underwriting and what's their experience? How many loans are they doing every month? And what is their default rate on the loans? Do they have a secondary market? What's their source of capital if it's not the funds? Because sometimes, a fund can be at capacity and you have to go outside of it. What happens if you have to take a property back? Just general risk, things like that you want to look at, that you should ask every lender who is offering a fund. And then maybe even, hey, I'd like to speak to a couple of investors who've been invested with you. In addition to the good things, what are some of the, what are some of the things that have happened, and how did you deal with those? Because no lender is perfect, and so and in the private lending space, people come to private money for a reason. It's not always because they're the most bankable client. But so you want to understand, what is your risk mitigation policy, things like that. So track record, talking to other investors, those are all important things that if you're an investor looking to make an investment in a fund, you want to ask those same questions of every lender.
And so what is your due diligence? What's your process for vetting out the borrowers?
Yeah, great question. So when you're looking at a borrower, you want to look at their, obviously the basics, like their credit profile and, what their assets are, and do they have the ability to make the payment? But then you want to look at the property and the real estate they're investing in, but also why and what's the story? Why are you coming to private money versus a bank?
Bank. Yeah. Yeah. That was
So
my next question. What is normally the reason for that?
yeah, I mean, it's any number, and I'll explain some of it by product type. So for our consumer bridge loan, which I've mentioned, that's somebody who is trying to buy their next home before they've sold their current home. Typically, if you're trying to make an offer, you're going out there and you have a home to sell still, you have to make a sale contingent offer. So when you're competing, and we all know right now there's still an undersupply of housing. So a lot of folks are competing against all cash. There's a lot of all cash buyers out there. And never in American history have so many people are sitting on an incredible amount of equity in their current home. It's hard to unlock that equity traditionally where you have to sell first. So that's why this bridge loan exists. But if you want to be competitive, you have to make a non-sale contingent offer to compete against all cash. So with a bridge loan, we allow that. That's what we do. What we're underwriting for is, can they sell their departing residence in the right amount of time? Is it priced properly? And can the borrower qualify for paying for our bridge loan while they also have a conventional mortgage? And generally, and is it realistic what the sales price is? We found that most of our borrowers are really high FICO borrowers, and they need the bridge more. It's not really an expense thing; it's a convenience thing, and they're willing to pay for it. So we're underwriting, to the story, which a lot of alt lenders do. And same with our other loan products. Really, it's they're coming to us oftentimes because private lenders like us generally can operate much, much faster than a bank. And somebody buying a property to flip, even though our private money interest rates are higher than a bank, it's worth it to them because they can get funds within a couple of weeks. Where if they work with a bank, it can take several months. And so that's why people come to private money, and that's why there's a robust market, because bank lending has not gotten easier, and private money actually has gotten easier. It's become much more streamlined, and as a market segment of lending, it's grown up a lot over the last 20 years.
So how do you deal with defaults? We know that obviously, like we talked about, risk is, there is risk in every type of investment, and you never want to not talk about the elephant in the room and what happens when that happens, if and when it does happen. How do you all handle that?
Sure. So we have a strong servicing team and asset management team. Generally, if somebody is there's a couple different kinds of defaults. Let's say it's payment default, where they're just not making the payments, they're falling behind. First rule is generally, you want to work with the borrower, understand why they've fallen behind, and try and, help them. Help them meaning, you don't file a notice of default right off the bat if you can avoid it, because that impairs their ability oftentimes to, get a refinance loan. Find out what their exit is and has it changed. Can you help them accelerate getting their home ready to sell? But worst case scenario is you have to move forward with the, filing a notice of default and foreclosing and taking the property back. And that's all part of our risk, when making loans. But really, it's at the beginning when you're making the loan where you're mitigating the most risk. And that's where, you have to obviously underwrite properly, but you also have to make sure that borrower has some skin in the game. And that's why we don't lend 90% LT loan to value. It's more like 70, give or take 5 percentage points, depending on the market. But 65 to 75% loan to value, that's significant equity that borrower has in the loan. Typically, they're not going to walk away from it. But if they, for unforeseen reasons, have to walk away and we foreclose, there's enough cushion in there for us to recoup any default interest or expenses in taking the property back and disposing of it, selling it or having to sell at a slight discount to market value. That's what our job is as the lender and fund managers, because we don't want our investors to have to worry about those things.
Yeah. So diversification within the loans itself too, are you offering acquisition versus construction and those type of loans, commercial versus residential?
Yeah, absolutely. And depending on the fund, the focus could be on any one of those. So like the Arrival Fund I mentioned is for acquisition bridge loans. Our Pacific Freedom Fund is kind of a mixed bag because that fund is used to fund loans, act sort of as a quasi warehouse line where the loans are held for a really short period and then sold off to the secondary market. Our Opportunity Fund is geared towards ground up construction. We're not doing and seeing or pursuing a whole lot of commercial or multifamily today, but when it comes back, then that's something we might use the Opportunity Fund for, or the Pacific Freedom Fund for. Yeah.
Certainly is interesting. The industry itself is very interesting and seeing a lot of growth in the industry.
I love this industry, and it's self-directed IRAs, and IRA companies like Preferred Trust. They're like such a good partner for our industry because it's an avenue for investors to participate. And as private lenders, generally, you have more deal flow than you have capital for. We're always chasing capital. Obviously, we're always chasing deal flow. So the more we can expose our offerings to investors, whether it's through a self-directed IRA or directly, the more we can do business, do more loans. And so there's
a whole lot of capital to unlock there in the retirement account industry that is untapped.
It is. And so, I think that's why we're always close to the cap, because so many people are interested in investing in mortgages. That 25% of our investor base or funds, assets under management is, invested through a self-directed IRA. So,
and we like it too, when we're talking with investment sponsors and those offering investments, it's captured capital too. Most people in a retirement account are not going to walk away with that cash. Cash investors, when they're in a deal and then the deal might be over, the fund might be finished, whatever the case may be, they're going to take that cash and they're on to the next best thing, or they're walking away with it because they want to go on a vacation or they want to buy a new car or whatever the case is. And you just can't do that with a retirement account. That's, you're really holding on to those funds for a long time.
Yeah. And you bring up a good point. So we have quite a few investors who are investing through their self-directed IRA, but they're investing in an individual note. And what will happen then is they get paid off. And if they are waiting for the next note, it's a highly competitive space trying to find that next loan. And they could be back in cash, and that cash can be idle for a period of weeks or months. So, we prefer that they invest that self-directed IRA funds in one of our funds, because then that money is always working for them. And they don't have to, they're paying us. That's why we get our management fee, is they're paying us to do the underwriting, the servicing, they, go through foreclosure in the worst case. And it's diversified across the portfolio and not just at 123 Main Street.
Right.
So, that's one
that's a great point. A lot of people say, well, I want to invest in real estate, but I don't want to do the work behind it. I don't want to have to be a property manager. I don't want to have to fix the property. I don't want to have to worry about all these things. And these funds are a great way to do that, be invested in real estate and not worry about all that ancillary stuff that, they don't want to handle.
Yeah. And, a lot of people don't realize that. They think, okay, well, I'm going to invest in this note. Maybe I won't be the sole investor in it, but I'll be a fractional investor. But, in 90% plus of the time, I think, that everything goes smoothly. But those times when you end up having to deal with the borrower directly because you're the direct investor, you're essentially the bank. That becomes, be careful what you wish for. Trying to collect payments, trying to foreclose. It's a long, drawn out process. And when you're working through a fund, we stabilize because we make those distributions to the investors, and we'll handle the costs of foreclosing, et cetera, all of those pain points, talking to the borrower. If we have to list the property, finding a realtor and listing the property and doing any rehab work that needs to be done. Those are all of the things behind the scenes that a lot of investors who want to invest in real estate don't, really feel the pain until something happens. And again, it doesn't happen often, but when it does, then sometimes
Sure.
people say, I never want to invest in real estate again.
Again, right.
Yeah.
Yeah.
And so, if they had known they can invest and be more passive and go through a fund, then that changes things a lot. And maybe they're giving up a little bit on the rate of return, but they can sleep better at night knowing they don't have to deal with the borrower.
All that stuff. Yep,
Yeah.
exactly. Yeah, we find that a lot too. Clients will start out with a fix and flip, or they'll have a rental property and it'll get to be too much. And they do make that comment, well, I don't want to ever do real estate again. Okay, well, there's so many different avenues of real estate. It doesn't have to be just those two options. And that's when we send them to our investment community to look for companies like yourself. So tell us a little bit about what the future of Pacific Private Money is. Like, what do you foresee in the next couple of years?
I would say the last couple of years have been challenging for lending in general, including, alternative lenders like Pacific Private Money, just because rates went up so fast in such a short period of time. I feel really bad for our conventional peers because, they were offering rates sub 3%. And then, within a year, it was 7%. I think we're seeing, so there were a lot of headwinds over the last 2 years. Now I'd say it's sort of neutral or flat. And I think as we go into 2025, we'll see some tailwinds in terms of rates coming down. And I think that's good for everyone. So we're bullish. It won't be, the free money that we saw in late 2020, but it'll be reasonable. And it will be normal, and normal is good, I would say. Well, I should say it'll be closer to normal. And normal for us is conventional rates being, in the 5 or 6s. And that means that alternative rates will be 8, 9, maybe 10% versus 9, 10, 11 or 12%, which it's been, at least in California. So I think we're going to see more on the residential side, more inventory coming on the market. Hopefully, builders can build at a profit. And so maybe we'll see more housing coming aboard, new housing. I would hope for that just because there's such an undersupply. But I think you'll see more just resale inventory coming on. And that's a market that we serve. And so, we're gearing up for that. We're hiring more loan officers. We're trying to expand our reach, as I mentioned, through more licensing. So we'll double the number of states we're licensed in for our bridge loans. And that just bodes well for investors in our funds because we expect our funds to grow. I'm optimistic about 2020.
Hey, can you name those 10 states for us? I've been wondering this. Can you name the 10 states?
Yeah, maybe I'll get to as far as like 4 or 5 more, but then I'll forget the rest. But we'll be in probably Virginia, Maryland. We'll be in starting with the Eastern Seaboard, North Carolina, Florida. We're already in Texas, but in the Western states, we'll be in Nevada, and we're already in Colorado, Arizona, Oregon, and Washington. So we're just filling out kind of the Eastern Seaboard and then a little bit of the Western and a little bit in between. But you can go to our website, pacificprivatemoney.com, to see the states where we're licensed in. But essentially, it's states where there's the large metro areas where there's migration. So for instance, a lot of people moving from California to Arizona, California to Colorado,
Las Vegas.
Las Vegas. I know we need to be in Nevada. People have been asking us to. On the Eastern Seaboard, a lot of people are moving from the Mid-Atlantic down to the Carolinas and Florida. People, when I say people, I mean like boomers who have lived in their homes for 30 years, probably own it free and clear, and are moving into the Sunshine States and downsizing. And the interesting thing is they have so much equity in their homes that they can't unlock that equity until they sell. And selling first is not working these days. So when they finally get into the new home through our bridge loan and they sell their departing residence, they don't need a loan anymore. They pay us off and they don't need a 30-year loan because they're going from at least in California, like $1.5 million home to 600,000. And they're just paying cash eventually, to they don't need a mortgage, which
Yeah.
is, there's this huge transfer of wealth that we're going to see over the next 10 years. And it's because so much equity is tied up, so much wealth is tied up with the boomer population. The other group are move up millennials. They already have been in their first home for, 5 to 10 years, probably have 50% equity just because of appreciation. And their family has grown and they need to expand because they have kids now or several kids. And so they need to move up. So the bridge loan is a great product or a great solution for those folks.
Yeah. Well, thanks. We're so glad that you were able to join us today. Is there anything that we didn't cover that you want to tell our listeners out there?
Really, no, just to explore, anyone who doesn't have a self-directed IRA to really explore that, because, whether it's you're investing in a mortgage pool fund, I mean, there's so many different investments out there that you can't get through traditional means. Like, and I'd say, as I mentioned earlier, the best kept secret, there's a lot of best kept secrets out there in different asset classes, real estate being, more, alts being one of them. But there's so many investments where, that pay better than a CD or pay better than like what you see or less volatile than the stock market. So I would just say to those who are, investors out there listening is explore what's available through a self-directed IRA, including us, of course.
It's easier to talk about what you can't invest in than what you can, because there's so many different options out there today, from digital currency to precious metals, to startup companies, real estate funds. I mean, there's just so many things out there, and diversification is key. That's always what we're trying to educate our clients on, and investors who are interested, and just get out there and invest in the things that you know and that you understand. And if you've ever bought a home ever, then you're a real estate investor. You know how that goes. So you are already an investor. You may not think so, but if you own your own property or ever have owned your own property, yes, you are. So just get out there and do something, but don't stay stagnant, for sure.
Ditto. Exactly. Yeah. Just look around, and there's so many opportunities out there.
Definitely. Well, thank you so much. We're so glad you were here today. And thanks for joining us out there, everyone. We're appreciating your time on another edition of The Preferred Way, and we will see you for our next podcast.
Thanks for having me.
Thanks.
Bye-bye.
Bye.
Thanks for joining us for another episode where retirement savers meet alternative investments. Can't wait for the next episode to learn more? Visit our website at preferredtrustcompany.com.